Hello and welcome to the look ahead for Wednesday, the 11th of September, with me, Fiona Cincotta, Senior Market Analyst at City Index. So tomorrow we will be watching out for UK GDP data. We've also got US inflation data, which is really the highlight for this week, and we've also got oil inventory figures, which will be very much in focus given the moves that we've seen in oil today. But let's just start with US inflation figures. As I said, this is expected to be the most keenly awaited, or it is the most keenly awaited macro data point this week. Expectations are for US inflation to cool to 2.6%, down from 2.9%. And the data is the final piece in the jigsaw before the Federal Reserve interest rate decision next week on September 17th and 18th. Now, the market is now widely expecting the Federal Reserve to cut rates by 25 basis points. Expectations for an outsized rate cut have eased back to around 30%, down from around 40% last week, when there were concerns over the need for a larger cut if the US economy was heading for a recession. Now, this data, I mean, if we get inflation cooling in line with expectations, that probably won't ruffle too many feathers, and we will just support the view that the Fed will be cutting by 25 basis points. However, if we see a significant fall in inflation or cooling in inflation, that I think could unnerve the markets and just add to those recessionary jitters that we saw across last week before the non-farm payroll report, as we saw weak data come in. Now, I'm just having a look here. This is the gold chart that we're watching. Obviously, we're looking for the Federal Reserve to cut interest rates, which tends to be beneficial for non-yielding gold. However, it's been interesting because gold hasn't necessarily benefited from those recessionary jitters that we might expect the safe haven to benefit from usually. So if we just have a look here in the chart, I mean, it's still trading in this rising channel that it's been trading in since the beginning of April. However, we are sort of seeing this consolidation here, capped on the upside by 2,530, capped on the downside by around 2,480. That's sort of the level that we've been holding in since mid-August. If we get a breakout above there, above that 2530, that's also the rising trend line, the upper band. So that could potentially spark a breakout to a deeper, higher level to around the 2600 level. However, if we do get stronger than expected inflation, which I don't necessarily think will happen, but if it did, it probably won't spark too much of a reaction in the market, just because the market's more concerned about the downside right now than it is on the upside. But if we do get some strengthening in the US dollar, that could negatively impact the price of gold, and we could see we'll be watching for sellers to break below that 2,480 level in order for a deeper sell-off. So other markets to be watching tomorrow when we get that inflation data through. Now, this is the NASDAQ. This is quite interesting. Obviously, we're seeing we would see sort of inflation, recession jitters play out in sort of falling demand for riskier assets such as stocks. And see, it's actually trading below this falling trend line that just dates back to mid-July, finding support again this week on the end of last week on the 200 SMA, as it did really around that sell-off at the beginning of August. So you know what, if we do get sort of more jitters and more concerns, obviously we've got the US presidential election going on this evening, that still hasn't happened ahead of this video, but any concerns, then that's the level to watch there. It's around the 18,300 to 18,250. So if we get a break below there, then that's going to bring the 18,700 level, 18,800 level into play ahead of this one down here, which is the August low, 17,250. If we find that this support holds and inflation cools in line with expectations and the market remains content that inflation is easing, the Federal Reserve will cut rates by 25 basis points and the soft landing is still on track, then that could be beneficial for the risk mood in the market, and in which case watch out for the 19,000 level on the upside ahead of the 19,400, which is that resistance of the falling trend line. Other ones we're watching out for, as I said, we've got UK GDP data tomorrow for July, month on month, expected to show 0.2% growth after stagnating in June. See, today we also had UK labour market data in. I think if we get that sort of stronger, well, it's not strong growth, but it's signs of growth. At least it's not. So at least it's not a contraction. If we get those signs of growth, then it does just support the view that the UK economy is just sort of keeping its head above water. We had the jobs data in today, showed that the labour market unemployment ticked lower, but wage growth also ticked lower. So it just supports the view that there is some cooling in the labour market and that the Bank of England is likely to cut rates again, probably in November. That's what the market's looking for. That's what it's pricing in. So we've seen again the pound has actually weakened away from that high of 132.65, which it reached at the end of August. It is still, as I point out, trading within that rising channel. I think you need to see a break below the 130 level for that near-term uptrend to be negated, and then on the downside look out for 129 if we break below the 130 level, but that would require some US dollar strength as well in order for us to see that happen. And I just going to touch on the last one is oil, because we've seen a breakout in oil, which has been really quite interesting. So if we just think about what's happened today in oil prices, in fact, they've been struggling since they hit that 85 level at the start of July. There are concerns over the demand outlook. That's really what's driving the oil prices lower at the moment. Not only are we getting sort of really subpar data in from China, today we had China trade data in, whilst exports were stronger than expected, imports were weaker than expected, really highlighting that weak demand environment in China, which is going to be difficult for Beijing to address without further stimulus. And then we've also got concerns over this slowdown in the US, the world's largest consumer of oil. So those demand concerns, the demand outlook, has weakened considerably, and basically that's overshadowed any supply issues that there might be at the moment. OPEC last week announced that they're not going to release or wind back the supply restrictions, which they were planning on doing in October. So that normally would offer some support to oil prices, but it hasn't. Nor did the larger than expected draw in US inventories last week. So all eyes on inventories this week to see if it offers some sort of break or indeed sends the market lower. Now look, it's breaking below this key level here, 67.50. This is a level that we saw in play back in December 23, back in June 2023 as well. That's really opening the door. Look at that. It's a bearish engulfing candle, opening the door really to this level here, which is the 63.50. Let me just double check that. 63.60. That was a level. It was the 2023 low. So that's going to be the next level that oil bears will be looking to break below. We're not quite in overbought territory, so just watch out for that on the downside. Any recovery first needs to retake that 67.50 level in order to be heading back up towards the $70 a barrel. So I hope you like what you've seen, and if you do, then please do give this video a like, and for more videos like this, then please do subscribe.